At this moment, the IRS holds guidelines nearly every American has skipped over. It's just that the rules aren't secret. Sometimes people miss what's right there. It never came up in conversation. That's why you didn't know. Every year, most families in the U.S. send extra money to Washington way more than they need to. That gap adds up fast, often landing in the thousands. For reasons unrelated to deceit. Nothing tied to errors either. A small hole in understanding caused it. Now the space shrinks. Here, distance fades. This moment bridges what was missing. The divide ends. Closeness arrives without warning. Here's something to consider before diving into tactics. One core idea shapes everything that follows. Most folks think taxes grab everyone fair, but that idea misses how rules actually work. A system built long ago still shapes who pays what today. Hidden details tilt results before numbers even get added. Some pockets stay full while others empty without notice. Rules favor certain paths more than others show on paper. What looks balanced at first glance hides uneven weight underneath. Written with an eye toward encouraging certain actions, putting money aside comes first, then grows it slowly over time. Starting something that makes things happens next. Work appears when people step up. Look at what goals the government rewards, then spot where the lawful benefits hide. A clear path opens when motives align with rules meant to encourage them. That year, someone filing a loan could pay as little as 10% in federal taxes. Moving up, rates climb step by step until they hit 37% for the highest earners. Each level applies only to income within that range. Higher earnings trigger higher percentages gradually. The structure spreads across several tiers, not one flat jump. When a married couple files taxes together, hitting $768,700 in taxable income means they reach the highest tax bracket. Yet reaching that level changes how much gets taken out. Once earnings cross that line, the rate jumps up, no exceptions, just numbers on a form adding pressure. Only a few make it there, though many aim somewhere lower. Reaching seven figures shifts everything quietly behind the scenes. For those filing alone, the amount they can subtract without itemizing stands at $16,100. Married pairs see that number double, landing at $32,200. Numbers shift slightly each tax season. This round brings these figures into play. What counts here isn't just what you earn. It's what remains once write-offs are taken out. That space between what you earn and what gets taxed, that's where your plan takes shape. Most folks overlook the easiest option right at their fingertips. Starting here makes sense, even if it feels odd. Next year brings a chance to put $24,500 into your 401k. Those 50 years old or more get space for an extra $7,500 through catch-up options. $32,000 shifts from your taxable earnings this year. Done within the law. Right now, right off the bat, stuffing your 401k to the limit means a $5,390 lighter load on taxes, assuming you're stuck in that 22% zone. Suddenly, more of your cash stays put instead of vanishing into government pockets. If your tax rate is 24%, then the amount jumps to $5,880. Here's the part nearly everyone overlooks. A path opens through tax rules when moving money into a Roth account. Step by step, funds shift after taxes are paid. Each year, another piece moves forward. This method works within current laws. People use it to access savings earlier than usual. Putting money into a traditional IRA or 401k means taxes are lower today. That benefit comes right away instead of later. Later on, once retired and living on less money, pull portions of that savings into a Roth account every year bit by bit. You end up taxed at a reduced rate when converting, while any gains after that stay entirely untaxed. What matters most is how much stays in your pocket down the road. A gap exists. From retirement until age 73, when mandatory withdrawals begin, income often dips to its lowest point across adulthood. Some folks spot a chance to shift cash out of taxed accounts into ones where it grows without tax. That gap becomes useful when handled right. By 2026, IRA contributions cap out at $7,500. Once you hit age 50, an extra $1,100 gets added on top. A person working for themselves can put money into a SEP IRA. Whichever amount is smaller, $72,000 or 1/4 of their income, that's the most they're allowed to add. A third layer slips in right after the first two, each building quietly on its own rules. Tax perks stack without announcement here. Each step moves under a different set of terms. A person puts money into a health savings account before taxes take their share. That cash grows without tax bites along the way. Money pulled out for medical costs stays free of extra charges too. By 2026, people pay up to $4,300 while families can go as high as $8,500. That year sets those numbers clearly in place. For folks 55 and up, an extra $1,000 gets tacked on. First layer. This gift cuts your taxes. Not every payment works that way. Inside the account, taxes can't touch any of the growth. Money builds without deductions piling up along the way. Here's how it works. Pulling cash for approved health costs means no tax hits at all. 3 layers of tax shielding exist here. Nothing else inside the tax rules works like this. Here comes the smarter play. Right now, there is no need to pay it back quickly. One way to handle medical costs now is using cash up front. Hold on to every receipt like they're tickets to a future refund. Your HSA balance? Let it sit untouched for 20 years or more. Years down the road, dig up those dated slips. Submit them out of nowhere, long after the fact. Get reimbursed without paying taxes on the withdrawal, even decades later. Once past 65, your HSA acts much like an old-style IRA. Withdraw money whenever needed, just expect regular income taxes, just as with a standard IRA payout. Medical costs? Still untouched by taxes, every dollar. A person must have a high-deductible health plan before using an HSA. In 2026, individual deductibles start at $1,650. Families face double that amount, hitting $3,300 minimum. Only then does access open up. Most folks who stay well find the money saved on premiums, together with the tax break from an HSA, easily handles the steeper out-of-pocket cost. Surprisingly few realize capital gains taxes aren't set in stone. Actually, they can be sidestepped. Come 2026, married couples who file taxes together won't pay any federal tax on long-term gains or eligible dividends, so long as their taxable income doesn't go past $98,900. That rate hits zero cleanly under those conditions. What counts is what you earn minus write-offs, not the total amount brought in. Money left once expenses are subtracted. Here is how a retired couple might actually live tax-free on investment income. A total of $120,000 came through investments. That amount shows what was earned before any costs were taken out. Take away the standard deduction, which is $32,200. 2 fewer cuts from Social Security taken out. Beneath that top-line subtraction, beneath $98,900 now sits taxable income. Nothing owed on capital gains. Tax stands at empty, flat out gone. Hold your investment past a 12-month mark. That's what counts toward lower tax rates on profits. Not every gain gets this treatment, only those lasting beyond 1 year. The label? Qualified dividends and long-term capital gains, says the IRS. Most rich people who retire without paying federal taxes didn't break rules. What they did was follow laws ones anyone could look up today. Their method isn't hidden somewhere secret. It runs through plain sections of tax law, open to all eyes. Not one bit involves fraud. The system allows it if you know where to find the openings. People living in places such as California, New York, New Jersey, or Illinois face a major shift in 2026 because of how taxes are handled. While tax rules change often, this update hits harder in those areas than elsewhere across the country. On July 4, 2025, a law called the One Big Beautiful Bill Act became official. Because of it, the limit on state and local tax deductions jumped fourfold. What was once capped at $10,000 now allows up to $40,000. This change opened more room for certain taxpayers when filing. Not every state saw equal impact, yet adjustments followed quickly. Here's how it works. SALT stands for state and local tax. Think of state income tax combined with what you pay on your home locally. Each area adds its own piece to the total. Now that limit kicks in when both income levies and land costs pile up across certain states. Where local charges weigh heavy, owners see relief through a cap on what counts toward federal bills. This setup allows offsets reaching $40,000 under specific conditions. When 2 types of taxation press hard, room opens to lower the total owed. Relief arrives not all at once, but where rules permit. A household in New York handing over $18,000 for state income tax along with $14,000 on property taxes now sees $32,000 more in write-offs this year, money that used to be blocked by limits. While those caps once held it back, the full amount counts again. 24% means $7,680 back just from one shift in policy folks still aren't seeing. That number? It hits harder when you realize it's already possible. Picture your taxes shrinking just because you own property in certain places. Not everyone qualifies. Earnings can block the benefit. Run actual figures past someone who knows tax rules well. The savings aren't imaginary, especially where local taxes bite hard. Running your own gig? Maybe just part-time hustle or freelancing on weekends. There's something tucked inside the tax rules called the qualified business income deduction that might apply. Not a giveaway, just a quiet line in the law that could matter. 20% might vanish from what you owe if it's tied to earnings that count under Section 199A. Taxes hit later after that piece slips away first. Running a consultancy pulls in $100,000 after expenses. Because of the QBI break, taxable earnings drop by $20,000 right away. Sitting in the 22% zone, that single insight keeps $4,400 yearly from going to taxes. One smart move, real results, no extra work needed. Now sticking around for good, thanks to a call from the OBBBA. No countdown ticking down anymore. Here it stays, no leaving anytime soon. Most small business people and those working for themselves find this tool extremely useful. Once earnings climb past specific levels, limits start applying to higher earning service providers. Yet it remains a strong option for many who run their own operations. 15.3% gets taken out for self-employment. Tax applies to each dollar earned. This happens before income tax even comes into play. A worker making $150,000 from their own business pays $22,950 as self-employment tax. This amount comes straight out of what they earn. It covers certain government requirements tied to independent work. The figure might seem high at first glance. Still, it follows standard rules applied across similar incomes. A different method kicks in when an S-corporation enters the picture. Most folks running an S-Corp set their own paycheck at what seems fair. Taxes tied to working for yourself stick just to that wage. Leftover earnings shift out differently, skipping those work-related taxes entirely. How much shows up depends on how profits break down. Start with $80,000 paid straight to you as pay. Then pull out $70,000 more, but call it a withdrawal instead. That means your self-employment tax applies to $80,000, not $150,000. That's a cut of 15.3% from $70,000, more than $10,000 each year. A full tenth plus half again, gone just like that. Every 12 months, it slips into savings instead. Money once spent now stays put. Over time, it piles up quiet and steady. This setup fits companies pulling in steady profits north of about $80,000 yearly. Under that mark, paperwork expenses tend to eat up any gains. Once past it, numbers start making sense almost immediately. Falling prices shake things up. Yet that jolt isn't only danger, it can be used. Movement turns into leverage. Sometimes you sell an investment after its price drops. That lets you count a loss on paper. You take that number into account when looking at profits from other spots in your collection of assets. Should that investment drop by $15,000, the setback might balance out gains elsewhere. A loss like this could cover an equal amount in profits from different trades. Should losses top gains, the tax agency permits cutting regular income by as much as $3,000 each year. Leftover losses keep moving into later years without end. Here's the key point. It's called the wash sale rule. If you sell a security, avoid repurchasing the same one or something nearly identical within 30 days on either side of that date. Instead, consider stepping into a different fund that follows the same index right away. That way, your position in the market stays intact even as you gain a tax advantage. Here's where digital money stands out. Right now, the government doesn't enforce the wash sale restriction on cryptocurrency, so if you offload Bitcoin at a loss and buy it back right after, you lock in that tax benefit without changing your stance. Most people won't find it worth listing deductions by 2026. Because of this, giving to charity the usual way stops cutting taxes. Yet one method shifts things entirely. Another approach alters the outcome just as much. One method goes by the name of bunching. Rather than giving $5,000 annually across 3 years, shift it all into 1 year $15,000 at once. That single year pushes itemized deductions past the standard amount. Suddenly, the bigger donation pays off fully on taxes. A different option involves what's called a donor-advised fund, putting a substantial sum into it during a year when earnings are strong. That move locks in an immediate tax write-off. From there, giving unfolds gradually, directed by you whenever ready. Shares that grew in value can go straight to a donor-advised fund or cause without triggering taxes. Skip the capital gains hit while claiming the current worth as a write-off. The growth stays untaxed, yet counts fully toward what you give. That benefit sticks, no future tax bill shows up. Buildings lose value on paper faster than they wear out, so owners pay less in taxes each year. That gap creates space where profits grow without extra cost. One way to look at it, the building's expense can slide off your taxes bit by bit across nearly 3 decades. That number shows up on paper, only no cash leaves your pocket. Even as that imaginary loss grows, the home itself might be gaining worth. Land stays out of the math entirely, just the structure counts. Year after year, the write-off chips away, quietly lowering what you owe. A house worth $300,000, where $220,000 counts as the building itself, gives $8,000 off each year without spending a cent. Depreciation works quietly in the background, reducing taxable income just by ownership. When you mix mortgage interest write-offs with property tax cuts and daily costs, rental units can show big fake losses on paper. These pretend numbers sometimes cancel out earnings from other sources. When you're deep in the day-to-day of managing rentals, every dollar lost cuts straight through your regular earnings. If that's not you, then tax limits kick in, yet those paper losses stick around, ready to trim down rental profits or shrink taxable gains when property changes hands later. Here's something aimed at folks holding company shares within their 401k plan. Surprisingly few realize how 401k withdrawals actually work. Inside such accounts, nearly everything gets hit with regular income tax. Yes, true for the bulk of what's held there. Yet shares tied to your job carry unique risks. Here's how it works. When moving company shares from a 401k through an in-kind transfer, taxes apply just to what you originally paid for them, nothing more. That chunk of value built up over time, it avoids regular income tax entirely. Instead, that gain gets treated like long-term capital appreciation. Years of holding those shares might mean a big difference in what you owe. The larger the increase, the bigger the benefit from lower tax treatment. That extra 37% tax? It drops to 20% when regular earnings become long-term profits instead. Dollars stay identical, just taxed less under new labels. Starting with a solid plan often means working closely alongside someone who knows the rules well. When it comes to big holdings in company stock, skipping smart moves might cost 6 figures in taxes down the road. This wraps up the points discussed moments ago. Hidden in the tax rules the IRS follows 10 ways lawyers use the system differently. Not loopholes, just choices most never notice. Each one built on how words are read, not changed. Some flip duties into opportunities. Others turn timelines upside down. One relies on timing that feels backward. Another leans on a definition buried near page 300. They do not break laws, they bend attention. What the government sees as owed, these approaches recast as movable. Numbers stay fixed. Interpretations shift. The code stays unchanged. Putting away the most allowed in retirement funds cuts taxes this year. Using the HSA as a triple tax-free vehicle. Capturing the 0% capital gains bracket. Claiming more of your state taxes under the bigger SALT break in places that charge higher rates. Taking the 20% QBI deduction as a business owner. Structuring as an S-Corp to reduce self-employment tax. Harvesting tax losses to offset gains. Stacking gifts in 1 year instead of spreading them out. Pair that with a fund set aside just for giving later on. Using real estate depreciation as a legal paper loss. Using gains still on paper from company shares held in a retirement account. Most of these approaches won't need legal experts at your side. What they do take is understanding. Most rich people aren't breaking new ground. They follow what's already written. Now you have read it too. Should a single thought from this clip spark something useful, pass it along to someone ready for that message. If diving further into these tactics interests you, drop a note in the comments. What happens next depends on what shows up there.